Okay, guys, welcome. My name's Dean Harris. I'm the Vice President of CrestCore Realty. Welcome to the Investor's Guide of Memphis Real Estate podcast. It's the podcast where we give out-of-state investors the boots-on-the-ground knowledge they need to win the Memphis real estate game. As always, I'm joined by Douglas Skipworth, and Douglas is our founder, principal broker of CrestCore Realty, CrestCore Property Management, and you're our largest client. I love to say that every time you eat the cooking. So, guys, you can listen to our previous podcast on Spotify, iTunes. We have a Facebook page, a YouTube channel. Just search Investor's Guide to Memphis Real Estate, and you'll be able to find all of that. If you have any questions, email me, dean@crestcore.com. I'll be happy to get right back to you. That's dean@crestcore.com. Hey, man, how are you?
Doing great.
That's great. Listen, today is a good topic. I'm excited about. You and I talk all the time about when you and I are saying, like, you know, we're asking each other about the market or whatever it is. I'm always saying we thrive in chaos. And that's probably a bad word, but we thrive in shifts and changes. And I believe we are at the beginning stages of one now. So it's going to be really important to get your market rent and to get your portfolio in shape and in condition for what some will deem as a little bit of a downturn in the market, but what savvy investors will look at as an opportunity.
Yeah.
So let's talk today. Today's show is going to be raising the rent and why. You know, matter of fact, we had 3 titles, right? Raising the rent, why, market rent, your portfolio power, like why this is important. So
now's the time to raise rents.
Now's the time to raise rents. I mean, you know, it was about 6 months ago, November. Well, it's more, I guess that's 8 now, close or 7. But I was talking to an investor who had a package of 25 homes, 26 homes. And he kept saying, but you can raise the rent up and get what you want. I'm like, what? Dean, I want this price, but my market rent suggests a much lower one. But if you raise it up, you can get up. This is the value. And I said, well, I mean, if McDonald's made a better hamburger, then it would be $15 and we'd all go. You know what I mean? Like, but unfortunately, it's not. It's $1 and it's terrible, you know, or whatever.
Right, yeah.
Whatever.
Yeah.
So I don't, you know, one of our first questions is, you know, how is market rent determined? But let's talk for just a second, like, you know, importances of this topic. I mean, like, from a portfolio standpoint, if you've got 20 houses in there and they're all 25% below market rent because you've been too lazy to do the work and the process to get it up, versus a same location type 20 house package property that is at market rent. I mean, talk about just for a second the values and the differences of those two.
Yeah, I mean, I think where you're going is that the value of the homes is, and the cash flow from the homes is where it's from your top line income. Like I've always loved residential real estate because it's simple. Yeah. It's like one revenue line. Rent. So that's the only source of income you have as a landlord, as an investor on a single family home, small multifamily home or property. So you got to get that right. And so I think that's your point, is that if you're not managing that, you're lowering the value of your property.
Big time.
Because you're not producing the cash flow if somebody wants to buy it, or you're just not getting the cash flow yourself to service the debt if you have debt, or just to cover the normal expenses as the taxes, insurance, maintenance, management. So
right. And it's like if you look around at any other business that it generates revenue, especially these big ones, restaurants or wherever, like, you know, they're always going up on prices. You know, everything is going to cover their business. I mean, there's a reason why people go up, either the demand there or they have to. Yeah. You know, one or the other. So in our market, I believe that the demand is there.
Yeah. And we'll get kind of to the high level philosophical right here about why this is important and what it is. But it's your only source of income for the rental property. Mm-hmm. But it goes back to Econ 101, supply and demand. Mm-hmm. And if there's a limited supply and there's a great demand, then the prices are going to go up. Yep. But there's also some fundamentals behind it that I don't think people give enough credit to. we've talked a few times recently about your young investor who said, the rent is this today, but I'm looking out in 10 years. So I think I told you I had a mentor who explained this to me, and it really clicked and I've seen it over the past 20 years as rents have increased over 20 years. Now, and so I can definitively say that rents will increase over the long term.
Mm-hmm.
Now, it might be lumpy and bumpy, and it might be a couple years flat, stair step. It's not going to be a smooth upward 3% a year. But history shows, much like the stock market, where you're betting on American industry and technology and where things are going in the future, that rents will increase. And rents are a function of personal income. That's what I didn't realize. You kind of like, I didn't understand where rents, how they got their value or where that came from. Yeah. But it comes from personal income. And if you think about it, most every investor, most every mortgage borrower knows that there's a rule of thumb for what the rent should be, or what a personal household should pay. What do you think the personal household?
25%, I believe.
20%, up to a third.
Up to a third.
You know, up to a third is the rule of thumb.
Yep.
So I just pulled an article that came out, published on yesterday, about New York City housing. Now, New York City housing through the pandemic got really awesome, but post-pandemic, it is a crunch. People want to be back in the city. Rents, the affordable, it's unaffordable.
Right. So
it says here that vacancies at affordable rents are at a 30-year low in NYC. But what was most interesting to me is it says that, the guideline that a household's rent should not be more than 30% of gross income. That's the guideline.
Okay.
Because half of the renters in New York City exceed that. So half of the new renters in New York City are paying more than a third. And it said over 33%. So a third of them are paying over 50% of their monthly income in rent. Right. And so again, if we go back to what that means to us as landlords, that means as income increases, rents will increase because people want to pay up to a third of their income in rent.
And you're answering the question is, how is market rent determined? And this is some of it.
This is the fundamental of it. Like the surface level is the market comps or the income approach. Like, can you get back into appraisal 101?
But what originally drives?
But what drives it is personal income.
Yeah.
So I went back and I got this awesome graph of hourly income over the past 40 years. Okay, so in 1980, people were making about $5 an hour.
Yeah.
Which translates to $10,000 a year in annual income.
Yeah.
And then I didn't do the math, but if you do a third of that, the rent ends up being about $250 to $400 a month that people would pay.
Okay.
So then you fast forward 20 years from 1980 to 2000, and now people are making $10 an hour. Yeah. Which translates to about $20,000 a year, which if you do the $20,000 divided by 12 to get your monthly, and you're talking about $500 to $800 a month in rent 20 years ago. You jump to 2022 and you're pushing $20 an hour. So it's almost doubled again, the income.
Yep.
And so what are rents? What are rents now? About $1,000 to $1,500.
So we're holding the
That's
pattern.
about a third of somebody's income on the average. So that's exactly where we are. But it's just not necessarily a smooth line up.
Right. And because people aren't looking back at trends and how real estate has gone, they're looking at this.
Because most people are come in and out. They're not in it for 40 years.
Right.
You know,
they come in and out, they don't realize it.
They come in and out, they don't realize it. And then all of a sudden, if they've been in it 40 years, they go, wow, look what's happened. And all it did was gave me just exactly what you talk about every time is like, well, what if you look out 20 more years?
And people are going to be credit because it wasn't me.
People are going to be paying $2,000 for rent to $3,000 for rent in 20 years.
And if you're in this for the long haul, the deal that might not be the greatest deal right now is going to be a good deal later.
That is, man, that in addition, there's so many like great points. And that to me was like one thing that I thought about was like, I have talked to so many investors, so many non-investors who used to be investors, who sold a property they wish they'd never sold, who had an opportunity to buy a property that they didn't. And so I think my advice to myself, to the listeners, to all, is like, if you find a property in a location that you like and that you would want to be in, and it's a fair price, you should buy it. If it's not a location you want to be in and it's not a price that you think is fair, you probably don't want to do it. Because if it's a good location that you're excited about at a price that you can stomach, you're going to look back in 20 years and be thankful as opposed to regret. Because guess what? I can look out the office window and see 2 properties I had an opportunity to buy when we moved over here.
And wish you had.
And I drive by them every day and wish I'd bought them. Because it was a good location and a fair price.
Yeah.
But at the time, I didn't want to pay a fair price. I just
wanted a deal.
I wanted a deal.
There are no deals.
I wanted a deal.
So this is live conversations that I'm living right now. So this is not really on our notes, but this is a live thing I'm living. I'm adjusting my personal buying right now. I like to talk about some of this with with our listeners and followers, that I'm going through this adjustment right now.
Mm-hmm.
A home that I bought last year, and especially 2 years ago, in my mind, that's where I still want to be. Okay.
Price-wise, to purchase.
To
purchase. You like that it's appreciated, but you want to go back and buy it.
I want to go back and buy it 3 years ago.
Yeah.
So what I'm having to do is I don't even mean get creative, because that makes it seem like I'm going outside of my buy box or whatever. I'm just having to buy it differently. It's not a buy right and it's not a buy wrong. I'm buying it differently, and with the mindset of 10 years down the road.
And rents have increased. So your monthly income for that property has increased over the past 2 years.
Yes.
Because it was slow and steady for many years.
Yeah.
And then it has shot up.
Right.
And so this has been a great opportunity. I mean, like, now is the time to raise rents. There is no doubt about it. Or another way to say it is, like, if you're not raising rents through this, you probably are leaving money on the table.
Well, I'd even go likely.
Likely. Now, there might be a nuance of why you aren't and how it's a better fit, but long-term tenant, something. But chances are you're losing money by not raising rents.
Just had an email yesterday on one of mine on Wayne Road over here in 38122.
Yeah.
Up for renewal. $895 was the new rent. They're paying $750. Okay.
And it's a 2-1-3-1.
It's a 3-1.5.
Okay. 3-1.5.
Yeah. And they're paying, no, it's a 3-1. Wayne.
3-1. Yeah.
They were paying $750. They've been there for 3 years. So 2 years ago, we took a price increase from $7 to $750. So the rent's been for like the last year and a half, right at $750. Well, the last
under market.
Yeah.
Now.
Now we're up for renewal. And
$895. Is that what you said? The market rate?
That's what the market rent over there is.
Yeah.
$895. I went to them and they, oh my gosh, no, we have to negotiate. I was like, I'd encourage you to call around. So the message to them was to call around and see. They came back and they said, would you take anything less than $895?
Would you please take anything less than that?
I told them I'd take $850 if they'd sign right now. And they did.
Yeah.
$100 more. I could have gotten that $45 out of them if I was going to squeeze them. Because I guarantee you, they called around to some other 3-1s right around here that were vacant and available and in good condition. You got to have all these things match up. That's
a supply and demand issue right now. That's a
supply and demand issue. So like if that tenant called, and I know they did, if they called around to others in 3 bedrooms, they were like, it's $900 or it's at least $850.
What are they going to, if they don't sign the lease with you, what are they going to do?
They're going to have to go move somewhere else in the same area and pay $850 and $895.
Correct.
So I did go to them and gave them a little bit of a break, 12 months, but I won't do it again next year.
Well, and it depends on what their history, right? You've got 3 years history. Are they taking care of it? Are they paying on time?
For 19 months in a row. That's why I did it. On time
exactly right.
for 19 months in a row.
Yeah, it's worth keeping people for certain reasons.
Yes, and that is one of them. If you're going to come in here, I looked, before the first, every month.
There you go.
So I gave them that $45. So in a year, that's going to cost me $550. But for them to pay on time,
Peace of mind. You don't have to worry about collections. You don't have to worry about any issues.
And I got $100 more. I got $1,200 more this year that I'm going to make than I did last year.
And you don't have the turnover of lost rent and the rehab expense.
That would for
Which,
sure
by
be
the way, the rehab
$3,000
right now,
minimum.
the prices are high for rehabs because of materials and shortage.
Demand.
Demand, supply and demand again.
So if you're that investor and they challenge you and they want to come back, use go back to your property manager and to your DPM here and just say, hey, look, challenge them to go look and call some other places and find out what the market rent is elsewhere. And as long as you're charging market rent and your house is, safe and clean and acceptable, you should be able to get it.
And they're going to be, that's a good thing you mentioned about your property manager. They should help you determine what the market rent is.
Mm-hmm. That's right.
When it comes to renewal time or on a new lease, that they will be able to say, hey, here's what we're seeing in the market. They'll go out to sources of data sources, but they've also got their internal data as well to analyze and say, hey, here's what the market rent should be. And so they were able to help you determine $895 is that market rent for that property.
Yes. And we got right at it, and I'm happy with it. So let's talk about for a second some of the ups and downs of or I guess some of the issues you're going to run into by having below market rent. I wanted to do just a quick exercise.
Okay.
Let's say your market rent. This is real quick and brief, and some you can use this or not. But let's just say your market rent was $1,000. Okay, times 12 is $12,000. We're going to minus, for easy math here, 30% taxes, insurance, maintenance, whatever it may be. That's going to net you $8,400 a year.
Mm-hmm.
If you divide that by let's say $1,000, about $125,000 house, you've got about a 6.7 cap. Usually we don't use these numbers for single families, but that's about you're going to be your return. Okay. Now let's say the market rent's $1,000 and you're only getting $875. Not a lot less, but less. Times 12, it's $10,500. Minus 30%, $7,350 divided by your 125. You're all the way down to a 5.8. You jump a full point. And if you don't think that matters, if you've got 10 and if you've got 20 and if you've got 30, we're talking in some cases in those hundreds and hundreds and hundreds of thousands of dollars difference in value that you could sell it for, or that anyone is going to put a value on it for. So if you don't think that email that I took yesterday about my property on Wayne Road over here, that wasn't a huge ordeal to me and a huge win for me, you're dead wrong.
Well, and there's also an opportunity cost, right? If you are a hardcore investor, and in that, I mean, you are just looking at numbers, and you're not thinking about what it does for the community or the family that lives there, but you're only looking at numbers. You take that $125,000, where can you put that and get a return? If you're getting a 7% return, 6% return, 5% return, if you're not maximizing your return through your rent rate, then you could go put that money elsewhere,
right?
At potentially a lower activity level, easier to monitor, as we've talked about, less active, more passive.
But you're running that risk of a lower value, and it's not properly managing your property, your home. That's right. I mean, it's just not. And so the importance of it, I think we've hit pretty hard. It's good exercise.
What do you think about the 1% rule as a rule of thumb for the rent of a value?
I mean,
to rent to value
up to a certain point, I think that's a good rule of thumb. Anything below $100,000 now, it's funny to say that, right? Now anything below $100,000 is going to be tough. But I do believe in that $1,000 or in that $100,000 to $180,000, you can get close to that 1%.
So if you bought a house for 150, you should, as a good rule of thumb, you should be looking to get $1,500 of rent.
Yep.
To know
14 to right now, people are buying $1,300, but
for 150, they're paying $150,000 for a $1,300 rental. So you got to know, but it's also helping you frame like where your potential rent rates could be, kind of as a range to kind of help you.
You're picking out a target.
Yeah.
Yeah, you're picking out a target, and I do think the 1% rule is still, you're still able to find that here. So I just my point is to talk about just the impact and the value or the impact that raising that rent can, and if you can't have on your property.
Mm-hmm.
You see what I'm saying? I want to make sure that we get that out there. With a 41% rise in rental figures for Memphis in 2021, what do you expect in 22 and 23? You rubbing your crystal ball.
Yeah. Ooh. That's, again, I think I go back to I think that the long-term driver is what we talked about, personal income. So that's going to continue to increase. Now, what we don't know is how the market reacts to that because of different issues in the market at the time. This is supply and demand over that period. It looks like right now that supply is tight and inflation is high. Mm-hmm. Demand isn't increasing. So one thing I see that I really see that affects that is like, it seems to me interest rates are high. Mm-hmm. So it makes it harder people are less likely to buy homes as interest rates go up.
Buying power goes down.
Supply of houses is still super tight, historic lows. So all that to say is like, there aren't a lot of great opportunities for people to buy houses right now. So what does that mean? They got to live somewhere. They're going to rent. So if you have a lot of people competing for rentals, then you get in that situation that you were just at. Love, I'd like to raise your rent. I don't want you to raise my rent. Okay, why don't you go look around? Would you take how much less than $8.95 would you take? I mean, because it's like you don't have other options because of the demand is so high and the supply so low. So I don't see that changing. I mean, I'm trying to keep my ears up and listen to what everybody's saying. I don't see that changing quickly. No, even though the Fed's raising rates and that's going to affect mortgages, but again, that's going to stop people from buying homes, swing it towards more renters. I'll never forget one time when it kind of dawned on me when a banker asked 10 years ago when they were like, well, what happens when you got all these rental houses? What happens when people start just wanting to buy houses? I was like, well, we'll sell them. And I was like that. And there's like, but if they don't want to keep them, we'll keep them as rentals. And all of a sudden it dawned on me like you're in a no lose situation.
None.
Because the upside and the downside take care of themselves, whether buying and selling. So anyway, all that to say is like when people can't buy houses, aren't you super glad you're a landlord because they're competing over your house? And then once they all want to buy houses, aren't you super glad that you own houses if you want to sell them?
Correct me if I'm wrong, but is the pattern of Memphis not the same as any other city that's growing and developing? Everything that's close and convenient is renting, is tenant based. Just about, right? I mean, correct me if I'm wrong, but Chicago and
we just talked about New York City,
New York and Dallas and these other places. San
Francisco.
Everything right in the city in the middle is tenant based and non-owner occupant.
Yeah.
If you want to live out in the burbs, they call it, well, then go out to where you can find that and drive in and you can have some home ownership. Our city's not doing anything different. So if anyone talking about hedge funds buying and all this other things that someone might say is a negative about Memphis, no, it isn't. This is the same thing that's happening in all other cities that are larger than ours.
For sure.
It's just developing here later because we're a smaller city.
Yeah.
So it's like it's all the pattern of if you want to live in Memphis and you want to live in Midtown or you want to live in Colonial Acres or you want to live where you're 10 minutes from everything,
you're going to pay more to be a homeowner or a renter.
One or the other, my man. It's not, you're not, this is no inferior treatment you're getting here in Memphis. It is the same as everyone else. If you'll go do that research, that's why, you know what I mean? Like I said that because of course, like in every other city, the residential real estate agents are griping about investor purchases. Well, that isn't changing. It's not going to change. It's not going anywhere. These guys have got so much money. It's not So you can either cry about it and woe is me, or let's adapt and let's learn how to buy and figure it out. And that's what I've had to do myself. I'm in the process. I mean, that's why I like sharing that. I'm changing the way that I'm buying right now, and I'm telling you guys to do the same thing. It's like, I'm not encouraging you to do something I'm not doing. I'm not getting deals at $60. I mean, 60 cents on the dollars. There's not. No, I've gotten some of those.
Oh yeah,
but they're not to be had. Right. They're not there. They're not out there. So I had to, the last 3 months I've been really going through this because I haven't bought much. But I haven't bought hardly anything. So what am I going to do? Am I going to sit here?
Right.
No.
But a flip side is if you're thinking that in some senses you're thinking that you're paying 110 cents on the dollar because you're reflecting back on old prices, but really you're paying 90 cents on the dollar.
That's exactly
because the dollar is worth more now.
It's worth more now, and in 10 years when I still have the property, because I've never sold anything and I don't plan on it. In 10 years when I have the property, it's going to be 30% more. Well, in 20 years when I have it, maybe I'm passing it on to my kids. It's 50 or 60% more than what we're getting.
And that's why. Again, I went back to the regret of like, if you find a good location, a neighborhood you want to be in, a part of town you want to be in at a fair price, do it. There are neighborhoods you don't want to be in, and it's not a good deal. Even if you find a good deal, you don't want to be in that neighborhood. You give some good advice about that. We do some zip code stuff on that. But when you find a place you want to be, go there, because rents over time are going to
go up. Last thing we'll talk about, our market is, there's a dirty word, it's inflation.
Oh, yes.
Inflation is impacting everything. How is this affecting our rental market in your mind?
The conventional wisdom says that real estate is a hedge for inflation and that you can raise rents as prices go up. Yep. And I can say that I have found that to be the case.
Yeah.
So that is my experience. That's my experience right this minute. We haven't had as much inflation over the past 40 years, but it has continued to be my observation, because guess what happens as inflation goes up? Personal income goes up, and those guidelines for people paying a third of their rent. People don't say, I'm making $1,000. I'm paying $1,000. Now I'm making more money. I'm going to stay in my $1,000 rental and save that money. People upsize their lifestyle. On the whole, most people upsize their lifestyle. So again, those rents keep going up. They keep upgrading the houses. I see inflation, and what I have seen is that rent rates have made up for that. Rental increases right now have made up for that.
So what I heard you just say is that, for one, you're moving on up to the east side.
Yes, always.
He's too young for that.
Yeah, man. Oh, man.
But what I am hearing you say is that investing in real estate is a great way to hedge inflation.
Yes.
And make sure that you're covered in these times.
Yes.
In other words, I'm going to be protected with my portfolio because I'm conscious and continuing to raise my rents to cover some expenses of maintenance and whatever it may be.
Materials have increased. Labor for that. But the taxes might go up a little bit. Insurance might go up a little bit.
Yep.
Rates might go up a little bit. But you can raise your rents, and as inflation is going up, so
then in 10 years,
keep that.
That's right. I don't think it's anything negative. I think it's actually a positive for us. That's why right
now it is.
And I've talked for years about the reason why I sell this product, and I've told you this a million times.
Yeah.
The reason why I sell this product is because when it's in the toilet, the market,
there are people buying and people selling.
Buyers are out of the woodwork and they're ready for deals. And when the market is on the way up and everything's going great, I have guys that are coming and wanting to get into real estate, and that's an awesome time as well to get into it. So I'm not okay with chaos, but market shifts are okay for guys that own rental properties, because we're going to, have you gone down in rent much? Like over your 20 years of investing, how many times have you had an $800 rental that now you can't get but $650? It doesn't happen.
It doesn't happen. Right. I could see if you let it fall in disrepair or was in a part of town that you shouldn't have been in.
Doing everything
but those two things are very much in your control, because you can see where a good neighborhood is, and you can keep a property up.
As I've said for the last year and a half, and Alec here helped us last week on the I loved the time lapse that you did, man.
Yes.
You saw the time
Yes.
lapse where we told you a year ago you needed to buy real estate. We came back and told
25%.
you 25%. So if you guys bought when I asked you to buy a year or so ago, you've made 25% in equity in your property. I'm telling you the same thing now with your market rent. Continue to go up on your market rent. If you don't, you're mismanaging your properties. Assuming you're taking care, like you just said, taking care, they're in areas that are desirable. I'm hoping you're not buying in areas that aren't, and I'm hoping you're taking care of your properties. But if you're doing those things that you're supposed to be doing and you're not raising your rent, you're mismanaging.
You mismanage it and you're leaving money on the table.
Yeah. So be conscious of that. Anything else you want to add?
No, that's awesome, man.
Guys, if you have anything else, Dean@CrestCore.com, Spotify, iTunes, our YouTube channel, and on Facebook, you can go and search Investor's Guide to Memphis Real Estate. Appreciate you, man.
Yeah.
All right. Talk to you guys soon. Thank you.